Good evening everyone. Welcome to my YouTube channel, which is Explore Yourself, Banking and General Knowledge, etc. Now I am going to describe about examination material MCQs for Bank of India's Credit Officer Recruitment 2026. Welcome to my Path to the Corner office where I discuss important Bank of India Credit Officer Examination 2026 MCQs with clear and practical explanations to help you climb the career ladder faster. In credit appraisal, the five C's of credit does not include which of the following? Answer D. Compliance. Question. The primary purpose of a credit rating assigned internally by a bank before sanctioning a loan is to answer A. Determine the interest rate slab and risk-based pricing. Debt service coverage ratio is primarily used by banks to assess. Answer A. The borrower's ability to service interest and principal repayment from cash accruals. A DSCR of less than 1 generally indicates. Answer B. The unit's cash accruals is insufficient to meet its debt obligations. Which of the following is not a fund-based credit facility? Answer C. Letter of credit. Term loan appraisal primarily relies on which of the following statements to assess repayment capacity? Answer C. Cash flow, fund flow, or projections. In appraisal of a project loan, debt-equity ratio ideally should be. Answer B. Within acceptable norms, generally not exceeding bank-specific industry benchmark limits. Break-even analysis in the credit appraisal is used to determine. Answer A. The point at which total revenue equals total cost. In the turnover method, NAIC committee for assessing working capital MPBF is generally computed as. Answer A. 20% of projected annual turnover with 5% margin from borrower. The turnover method for working capital assessment under NAIC committee recommendations is typically mandated for borrowers with fund-based working capital requirement up to. Answer B. Rupees 5 crore. In the MPBF method, Tandon committee method 2, the borrower is required to bring in as margin. Answer A. 25% of current assets financed from long-term sources. Net working capital is calculated as. Answer A. Current assets minus current liabilities. The cash budget method of working capital assessment is most suitable for. Answer, answer B. Seasonal industries and service sector contractors with irregular cash flows. Drawing power DP in a cash credit account is calculated based on. Answer B. Value of stock and book debts after deducting margin subject to sanction limit. If drawing power is lower than the outstanding balance in a cash credit account, this situation is referred to as. Answer A. Excess drawing or irregularity in the account. Inventory holding period as a component of the operating cycle is calculated using. Answer A. Average inventory by cost of goods sold into 365. As per NPA IRAC norms, a term loan account becomes NPA if the instrument remains overdue for a period of. Answer C. More than 90 days. A cash credit overdraft account is classified as NPA if it remains out of order for a continuous period of. Answer C. 90 days. An account is considered out of order if the outstanding balance remains continuously in excess of the sanctioned limit drawing power for. Option B. 90 days. Under IRAC norms, a substandard asset is one that has remained NPA for a period. Answer A. Less than or equal to 12 months. The asset is classified as doubtful if it has remained in the substandard category for a period of. Answer B. More than 12 months. A loss asset under IRAC norms is one where. Answer A. The loss has been identified but the amount has not been written off fully. As per IRAC norms, the provisioning requirement on the secured portions of a doubtful asset up to 1 year is. Answer B. 25%. Provisioning requirement on the unsecured portions of doubtful asset is. Answer C. 100%. Standard provisioning norm for advances to the agriculture and SME tax sectors under the standard assets category is generally. Option A. 0.25%. Under the SARFAESI Act 2002, a bank can take possession of secured assets without court interventions after issuing a demand notice under Section 13(2) and allowing a period of. Answer B. 60 days. SRPIC Act provisions for enforcement of security interest are generally not applicable where the outstanding amount is less than answer B rupees 20% of the principal and the interest amount. A special mention account SMA category SMA 2 refers to an account where principal or interest is overdue between answer C 61 to 90 days. As per current RBI guidelines, the overall priority sector lending target for domestic scheduled commercial banks is answer B 40% of NBC. Within priority sector, the target for agriculture is option B 18% of NBC. Within the agricultural target, the sub target prescribed for small and marginal farmers is option B 10% of NBC. Priority sector target for weaker sections is option C 12% of NBC. Under priority sector norms, loans to micro enterprises are subject to a sub target of answer A 7.5% of NBC. Which of the following is not classified under priority sector lending? Option D loans to large corporates for capital market investments. Education loans qualify as priority sector advances up to a maximum limit of option answer B rupees 20 lakh respect of place of study. Under Basel 3 norms, the minimum capital to risk weighted assets ratio prescribed disclosure CCB is answer B 9%. Basel 3 introduced an additional capital conservation buffer of answer B 2.5%. Under Basel norms, Tier 1 capital primarily consists of answer B common equity and disclosed reserves core capital. The three pillars of the Basel 2-3 framework are minimum capital requirements, supervisory review process, and answer A market discipline. Risk weighted assets primarily account for which types of risk? Answer A credit risk, market risk, and operational risk. Liquidity coverage ratio under Basel 3 requires banks to hold sufficient high quality liquid assets to survive a stress scenario lasting. Answer C 30 days. Hypothecations as a mode of creating charge differs from pledge mainly because answer A possessions of assets remains with the borrower in hypothecation. In a pledge, the essential feature is that answer B possessions of goods is transferred to the lender pledgee while ownership remains with the borrower. Pledge as defined under the Transfer of Property Act 1882 is a charge created on answer B immovable property to secure a loan. Among the types of mortgage, the most preferred by banks due to its legal strength is answer C English mortgage. Equitable mortgage is created by answer B deposit of title deeds with intent to create security generally without registration. Lien gives a banker the right to answer B retain possessions of goods securities of the borrower until the debt is repaid. Assignment as a mode of charge creation is commonly used for securing which type of asset? Answer B life insurance policies and book debts. Registration of charge with the Register of Companies (ROC) under the Companies Act must be done within how many days of creation of charge as per current provisions? Answer A 30 days extendable up to 60 days with additional fee. Civil primarily maintains and provides answer A credit information of credit scores of borrowers. The civil score typically ranges from answer B 300 to 900. Besides civil, TransUnion Civil, which of the following is also a licensed credit information company in India? Answer B Equifax. External credit rating agencies like ICIL, ICRA and KRA assign ratings that primarily reflects answer A the borrower's ability to service debt obligations, creditworthiness. A credit rating of A assigned by a rating agency denotes answer A highest safety with lowest credit risk. Ratings below investment grade BB and below by CRISIL generally indicate answer B moderate to high risk of default. As per the MSME classification post 2020 revisions, a micro enterprise in manufacturing services is one with investment plant and machinery equipment up to answer A rupees 1 crore and turnover up to rupees 5 crore. Under the revised MSME classification, a medium enterprise has investment up to rupees 50 crore and turnover up to answer B rupees 250 crore. RBI framework for resolutions of state assets requires lenders to implement a resolution plan within a review period of Answer A, 30 days from default. Prudential framework. June 19 circular. One-time restructuring scheme for MSME allow restructuring of accounts that were standardized on a specific type of debt without downgrading asset classification subject to answer A, RBI specified conditions on eligibility criteria including account not being NPA as on specific debt. Under RBI's prompt collective action framework, banks are placed under PCA based on breach of threshold relating to capital, answer A, capital, asset quality, and net NPA and profitability leverage. Current ratio is calculated as answer A, current assets by current liabilities. The ideal benchmark for current ratio traditionally accepted by banks is approximately answer B, 1.33 is to 1. Quick ratio, asset test ratio differs from current ratio when this excludes answer B, inventory, stock, and prepaid expenses. Gross profit ratio is calculated as option A, gross profit by net sales into 100. Return on capital employed measures answer A, the efficiency of capital used to generate operating profit. Inventory turnover ratio is calculated as answer A, cost of goods sold average by average inventory. Declining debtors turnover ratio over successive years generally indicates answer B, deteriorating efficiency by slower collection of receivables. Proprietary ratio net worth to total assets indicates answer A, the extent to which assets are financed by owners' funds. The Banking Regulation Act 1949, Section 20 prohibits banks from answer A, granting loans against their own shares. Under Section 21 of the Banking Regulation Act, the RBI is empowered to answer B, issue directions to banks regarding advances policy. The base rate MCLR repo linked lending rate regime primarily governs answer A, the minimum rate below which banks generally cannot lend. As per current RBI guidelines, floating rate loans to retail and MSME borrowers must be linked to an external benchmark, most commonly answer A, repo rate. Consortium lending refers to a situation where a single answer B, multiple banks jointly finance a large borrower under common documentation with a lead bank. Multiple banking arrangement refers from consortium lending because answer A, banks lend independently without common documentation or information sharing formally coordinated. As per RBI norms, banks are required to obtain a declarations from the borrower and share credit information with other banks, CICs periodically to check answer A, multiple financing and diversion of funds. Willful defaulter, as per RBI guidelines, refers to a borrower who, answer A, has defaulted despite having the capacity to repay or diverted siphoned funds. Bank guarantee is classified as a answer B, non-fund based contingent facility. Letter of credit primarily serves the purpose of answer A, assuring payment to the seller beneficiary on behalf of the buyer subject to compliance with terms. Bill discounting involves the bank answer A, purchasing a bill of exchange before its maturity at a discount, extending credit to the seller. The document creating a charge and personal obligations on the borrower to repay the loan, typically executed at a time of loan disbursement, is called answer A, deemed promissory note, DP note, or loan agreement. Limitation Act 1963 is relevant to a credit administration because it prescribes answer A, the time period within which a suit for recovery of debt must be filed. Generally, the limitation period for filing a suit for recovery of a loan is a simple contract debt is answer B, 3 years from the date of default or last acknowledgement. A balance confirmation acknowledgement of debt from the borrower is important primarily to answer A, extend the limitation period for recovery proceedings. Kisan credit card cases schemes primarily provides answer B, short-term co-op loans along with allied activities and consumption needs in a flexible revolving format. The government interest subvention scheme short-term co-op loans up to rupees 3 lakh are eligible for interest subventions with an additional prompt repayment incentive for farmers who repay on time, bringing effective interest rates to approximately option A, answer A, 4%. The scale of finance for a co-op used in agricultural loan assessment is fixed by answer A, the district level technical committee based on cost of the cultivation. In the process, the loan limit for the first year is generally arrived at by adding scale of finance for co-op plus 10% towards post-harvest household needs plus provisions for insurance and further increased by how much for the second, third, fourth, and fifth year to account for cost escalations. Answer B. 10% each successive year. Collateral security or margin is generally not insisted upon by banks for agricultural loans up to answer B or rupees 1.6 lakh. Long-term agricultural loans are typically provided for which of the following purposes? Answer A. Purchase of tractors, land development, minor irrigations, and allied activities. Pradhan Mantri Mudra Yojana provides loans up to rupees 20 lakh post services to non-corporate, non-farming, small and micro enterprise categorized under three schemes. Answer A. Sisu, Kishore, and Tarun. Under PMMY, the Sisu category covers loans up to answer A. Rupees 50,000. Then the plan thus for micro and small enterprises primarily provides answer B. Collateral free credit guarantee covered to eligible lending institutions for loans destined to micro and small enterprises. Startup India scheme primarily facilitates bank loans between rupees 10 lakh and rupees 1 crore to answer be at least one SC/ST borrower and one woman borrower per bank branch for setting up greenfield enterprises. PM Vishwakarma scheme is primarily targeted at answer A. Traditional artisans and crafts people. PMEGP is implemented through which nodal agency at the national level. Answer B. KVIC, Khadi and Village Industries Commission. Pre-shipment credit packing credit is extended to exporters to finance. Answer A. Purchase of raw materials, processing and packing of goods prior to shipment. Post-shipment credit is extended to an exporters. Answer B. After shipment of goods against export documents till realization of proceeds. Maximum period for which pre-shipment credit in rupees can normally be extended at concessional rates before turning overdue is answer D. 365 days. ECGC Limited primarily provides answer A. Credit insurance covered to exporters and banks against risk of non-payment of by overseas buyers. FEMA guidelines export data processing and monitoring system is used by banks to monitor and reconcile realizations of export proceeds against shipping bills. As per RBI FEMA norms, export proceeds must generally be realized and repatriated to India within answer B 9 months from the date of export. In housing loan appraisal, loans to value ratio for loans up to rupees 30 lakh is capped by RBI guidelines at approximately answer C 90%. Fixed obligations to income ratio used in retail loan assessment measures answer A. The proportion of borrower's income committed to fixed repayment obligations EMIs. Under a floating rate home loan, RBI mandates that banks must not levy which of the following on the borrower. Answer B. Foreclosure prepayment charges on floating rate loans to individual borrowers. Reverse mortgage scheme is primarily designed for answer A. Senior citizens to monetize their own residential property while continuing it to reside in it. Debt Recovery Tribunal has jurisdiction to entertain recovery suits by banks or FIs for debts of answer B rupees 20 lakh and above. The Insolvency and Bankruptcy Code IBC 2016 provides a time-bound resolution process for corporate insolvency with the corporate insolvency resolution process mandated to the completed within answer B 180 days, extendable to 330 days including litigation time. Under IBC, the authority adjudicating corporate insolvency matter is the National Company Law Tribunal NCLT. Lok Adalat as recovery mechanism is generally used by banks for answer B. Small value NPA accounts for amicable and compromise settlement. A compromise settlement, one-time settlement OTS with the borrower typically results in so recovery of an agreed reduced amount in full and final settlement of dues. Relic requires banks to report credit information on borrowers with aggregate exposure of answer A rupees 5 crore and above. Stock audit of a borrower's inventory and book debts is typically mandated by banks for cash credit accounts where the exposure exceeds the threshold primarily to answer A. Verify the genuineness and valuation of security offered as primary security. Early warning signals in credit monitoring are indicators used to answer A. Identify potential signs of stress or fraud in an account before it turns NPA. As per RBI's fraud risk management guidelines, accounts classified as red flag accounts are those where answer B suspicious potential fraud indicators are observed or warranting closure investigations. Diversion of funds by borrower as identified during a forensic audit refers to answer utilizing loan funds for purposes other than those for which the loan was sanctioned. If a term loan is granted additional finance to a stressed borrower, the additional facility is generally classified as should be in the same asset classification category as the existing restructured credit facility. As per IRAC norms, in respect of consortium advances, asset classifications of borrower accounts should be done by each bank in the consortium independently based on its own record of recovery. If an NPA account is upgraded to some standard category after the borrower clears all overdue amounts, provisions held earlier can be reversed. This will be only after the account demonstrates satisfactory performance for a specified period as per the bank's board approved policy and full arrears are cleared. Under IRAC norms, restructuring of a loan account refers to NCB a modification in terms of the loan, extension of tenure, reduction in rate, conversion of interest to equity due to borrower's financial difficulty. When a standard account is restructured, it may be retained in the standard category, subject conditions, but such restructuring requires answer B. Additional provisioning as prescribed by RBI and monitoring under the specific framework. Interest income on an NPA account should be recognized by the bank. Answer B. Only on actual realizations, cash basis, not on accrual basis. As per SARFAESI Act, securitization refers to answer A. Acquisition of financial assets by an SCARC through issuance of security receipts to qualified buyers. Under SARFAESI, an asset reconnaissance company is primarily engaged in answer A. Acquiring NPAs from banks, FIs, managing their resolutions recovery. Which category of security interest is specifically excluded from the purview of SARFAESI Act enforcement provisions? Answer A. Security interest in agricultural land. Under Section 13(4) SARFAESI Act, after expiry of the notice period, the secured creditor may take possession of secured assets and also has the right to answer B. Take over management, sell or lease the secured assets to recover dues. An aggrieved borrower can file an appeal against measures taken under Section 13(4) SARFAESI before the answer A. Debt Tribunal Temporary DRT. Prior to filing an appeal before DRT under SARFAESI Section 17, if the borrower wishes to appeal to DRAT against a DRT order, the borrower is generally required to deposit what percentage of the amount due as a precondition. Option answer B is 50%. Under RBI's framework for resolution of stressed assets, if a resolution plan is not implemented within the specified review period for large accounts, banks are required to make additional provisioning of answer 20% of the total outstanding in a phased manner. Willful default identifications and reporting to RBI CSIs by banks requires action from an internal committee, typically headed by this will be a committee including senior officials, often headed by ED, whole-time director, with a review committee headed by the CEO or MD. Provisions for standard structured assets, as distinct from a normal standard asset, is generally kept at a higher rate, currently prescribed at answer C 5%. While analyzing a borrower's balance sheet, contingent liabilities disclosed in notes into accounts should be treated by a credit officer as answer B potential failures obligations that could impact the borrower's financial positions if crystallized. If a firm's tangible net worth is being calculated, which of the following is typically deducted from the net worth? Answer C. Intangible assets like goodwill, patents, and accumulated losses. A sudden and significant increase in sundry debtors without a corresponding increase in sales could indicate possible over-invoicing, diversion of funds, and slow-moving or doubtful debts. Window dressing of financial statements refers to answer B. Manipulation of accounts to present a more favorable financial positions than actual, often temporarily. In funds flow statement analysis, an increase in a liability or decrease in an asset is treated as answer B. A source of funds. Total outside liabilities to tangible net worth ratio is used by banks to assess answer B. The extent of borrowers leveraging dependence on external funds relative to own funds. A high and rising TOL TNW ratio over successive years generally signals answer B. Increasing financial risks due to greater reliance on borrowed funds relative to owned capital. Interest coverage ratio is computed as EBIT interest expenses. A declining interest coverage ratio over time most directly signals answer B. Weakening ability to service interest obligations from operating earnings. If a borrower's current ratio appears healthy but a large portion of current assets consist of slow-moving obsolete inventory, the credit officer should answer B. Adjust qualify the analysis since the quality of current assets matters as much as the ratio itself. Contribution margin in cost volume profit analysis is calculated as answer A, sales minus variable costs. A firm's operating cycle or working capital cycle length is important to a credit officer primarily because it determines answer with the period for which working capital finance is required, the time from cash outlay to cash realization. When comparing a borrower's projected and actual financial performances, projected versus actual analysis, significant unexplained variances should prompt the credit officer to answer B. Investigate reasons for deviation as it may indicate weakening fundamentals or unrealistic projections. Notes to accounts and auditors' qualifications in a borrower's audited financial statements are important to review because they are purely formal disclosures with no bearing on credit decisions. Answer B. They may reveal material issues like contingent liabilities, going concerns doubts on accounting liabilities affecting creditworthiness. In assessing sustainability of debt, a credit officer typically evaluates trends over a period of financial statements rather than a single year because answer B. Trend analysis reveals the consistency detection of financial performance and helps detect one-off anomalies. A firm has current assets of rupees 60 lakh and current liabilities of rupees 40 lakh. The current ratio is answer B 1.5 is to 1. A firm has current assets of rupees 60 lakh, 80 lakh, including inventory of rupees 30 lakh and prepaid expense of rupees 5 lakh and current liabilities of rupees 45 lakh. And its quick ratio is approximately option C 1.78 is to 1. A borrower's annual net worth after tax is rupees 12 lakh, depreciation is rupees 3 lakh, and annual interest on term loan is rupees 5 lakh. Annual installment obligation is rupees 10 lakh. What is the DSCR? Correct answer is option answer B 2. Using the standard formula DSCR, net profit after tax plus depreciation plus interest on term loan by interest on term loan plus term loan installment. If net profit after tax is rupees 8 lakh, depreciation is rupees 2 lakh, interest on term loan is 4 lakh, installment of is 6 lakh, the DSCR is answer B 1.4. Units projected annual turnover is rupees 4 crore under the NAC committee turnover method. The working capital requirement is assessed at 25% of turnover, rupees 1 crore of which the borrower must bring in margin for 5% of turnover, rupees 20 lakh from long-term sources. The bank's MBBF under this method would be answer B rupees 80 lakh. A firm's total outside liabilities are rupees 90 lakh and tangible net worth is rupees 30 lakh. Its TOL/TONW ratio is answer B or 3 to 1. The company JV is rupees 40 lakh and annual interest expense is rupees 8 lakh. The interest coverage ratio is option B 5 times. A firm has net sales of rupees 5 crore and average inventory of rupees 50 lakh. The inventory turnover ratio is answer B 10 times. A firm's net profit is rupees 15 lakh and net sales is rupees 3 crore. Its net profit ratio is answer B 5%. The borrower requests a cash credit limit projected stock at rupees 50 lakh and book debts less than 90 days are of 20 lakh. Margin stability is 25% of stock and 40% of book debts. The drawing cost would be answer A 40 rupees 42.5 lakh. A term loan of rupees 60 lakh is to be repaid on equal annual installments over 10 years, with the first installment starting 1 year after the moratorium period. What is the annual principal installment excluding interest? Answer A rupees 6 lakh. If a firm's debt equity ratio is required to maintain at 2:1 and its equity net worth is 25 lakh, the maximum debt can be raised while complying is answer C rupees 50 lakh. CBS in the context of Indian banking stands for answer B core banking solution. In a core banking solution environment, all branches of a bank are connected to answer B a centralized server data center enabling anytime anywhere banking. NEFT operates on which settlement basis? Answer B deferred net settlements in batches currently near real-time half-hourly cycles. RTGS is primarily used for answer B large value time critical transactions settled individually and instantly. Minimum amount typically rupees 2 lakh. IMPS is unique in that it enables fund transfer. Answer B 24 into 7 365 including holidays with near settlement. In digital banking, two-factor authentication typically combines answer B something the user knows, PIN password or something the user has, OTP token biometric. A firewall in a bank's IT infrastructure is primarily used to answer B monitor and control incoming outgoing network traffic to prevent unauthorized access. Phishing as a cyber fraud a technique typically involves answer B fraudulently obtaining sensitive information by masquerading as a trustworthy entity, often via email, SMS, fake websites. Data encryption is in banking transactions ensures that answer B data is converted into a coded form to prevent unauthorized access during transmission and storage. The Reserve Bank of India was established under the RBI Act in answer A 1935. The Monetary Policy Committee of RBI primarily decides answer B the policy repo rate to achieve the inflation target. The current inflation target mandated for IMPC is answer B 4% with a band of plus minus 2%. Cash reserve ratio refers to percentage of a bank's net demand and time liabilities that must be maintained as answer B cash balance with the RBI. Statutory liquidity ratio requires banks to maintain a certain percentage of NDDL in the form of answer B approved liquid assets like cash, gold, and unencumbered government securities. The apex institutions for refinancing and regulating regional rural banks and providing agricultural rural credit aid answer B NABARD. CDB primarily focuses on refinance and development support for SME micro, small and medium enterprises. The deposit insurance cover provided by DICGC and deposit per bank is currently answer B 5 lakh. Bank of India was nationalized in which round of bank nationalizations? Answer A 1969 first round. Delegation of financial powers in banks refers to answer A the authority is vested in different levels of officers to sanction loans up to specified limits. A proposal beyond the sanctioning power of a branch manager is typically referred to the next tier of sanctioning authority, regional zonal head office as per delegation matrix. Loan syndication refers to answer B, a group of banks FIs jointly arranging and providing a large loan to a single borrower coordinated by a lead arranger. In syndicated lead lending, the bank that structures the deal and coordinates among participating lenders is known as the answer B lead arranger or lead bank. Credit monitoring arrangement CMA data submitted by borrowers primarily includes answer B historical and projected financial statements including operating statement, balance sheets and fund flow used for assessment and monitoring. Review renewal of a working capital limit is generally undertaken by banks. Answer B periodically, commonly annually based on updated financial and conduct of the account. If a working capital account is not renewed within the stipulated time frame after its due date, RBI norms may require the bank to answer we treat the account as irregular and consider appropriate asset classifications provisioning as per policy. Takeover of accounts from another bank FI is generally guided by answer B board approved policy including the diligence on reasons of takeover, conduct of account and open a cooling period since last irregularity. A key red flag while considering takeover of accounts from another bank is answer B frequent takeover request by the borrower shifting between banks often to escape scrutiny or restructure informally. Net present value of a project is calculated as answer A sum of discounted cash flows minus initial investment. A project is generally considered financially viable under the NPV method if answer B NPV is positive or zero at the required discounted rate. Internal rate of return is defined as the discount rate at which answer A NPV of the project equals zero. A project is typically considered acceptable under the IRR method when answer B IRR is greater than or equal to required cut-off rate. Payback period method of project appraisal measures answer A the time required to recover the initial investment from net cash flows. A key limitations of the payback period of method is that if answer B ignores cash flows occurring after the playback period and does not account for time value of money in its simple form. Sensitivity analysis in project appraisal is used to answer B assess how changes in key variables, sales price, cost, volume impact project viability returns. Debt service coverage ratio over the loan tenure rather than a single year DSS is preferred by banks because it smooths out year-to-year fluctuations and gives a better picture of overall repayment capacity across the loan tenure. Promoters' contributions margin in project financing typically refers to answer B the portion of project cost that the promoter must bring in from own source equity not financed by debt. While lending in a partnership firm, the credit officer should specifically verify answer B the partnership deed, registration status, and authority of partners to borrow execute documents. In a partnership firm, liability of partners for the firm's debts is generally answer B joint and several unlimited extending to personal assets. While in lending to a undivided family age, the loan documents are typically executed by answer B the Karta who has authority to bind the age for legal necessity benefit of the state. Lending to a private limited company requires the credit officers to have examined, among other things, answer a memorandum and articles of association, board resolution authorizing borrowing, and certification of incorporation. The borrowing powers of a company board of directors, especially to borrow beyond paid up capital and fee reverses reserves, generally require answer the approval of shareholders by special resolutions. A society or trust seeking a loan should have its borrowing authorized primarily by answer its registered by law and trust deed and the regulations of the governing body managing committee. Liability of the members in a limited liability partnership LLP is generally answer be limited to their agreed contributions in the LLP similar to a company. Valuation of immovable property offered as collateral should ideally be conducted by answer B an approved and impaneled valuer independent of the borrower periodically as per bank policy. Insurance of securities charged to banks should typically be taken with the bank's interest noted as answer B loss, play, or mortgage clause in favor of the bank. If insurance on hypothecated stock lapses and is not renewed, the primary risk to the bank is answer B loss of insurance cover in case of damages, loss of stock, weakening the bank's security position. A guarantee given by a third party and to secure a loan creates answer B a secondary collateral obligations whereby the guarantor becomes liable to pay if the principal borrower defaults. Under the Indian Contract Act, the guarantor's liability is generally considered coextensive with that of the principal debtor unless the contract provides otherwise. The continuing guarantee covers answer B a series of transactions over a period of time until revoked. Gold loan facilitators are typically assessed by banks based on answer B value of gold ornaments, jewelry, purity rate placed subject to RBI prescribed LTV cap. As per RBI norms, the maximum loan to value ratio permissible for gold loans, non-agricultural jewelry bag is generally capped at answer B 75%. A performance guarantee, a type of bank guarantee is issued to assure the beneficiary of answer B satisfactory performance completion of contract by applicant. A financial guarantee differs from a performance guarantee in that it answer A assures payment of a specific financial obligations, earnest money advance payment rather than contract performance. A letter of credit that can be amended or cancelled by the issuing bank without the consent of the beneficiary is called a answer B revocable LC. Under UCPDC guidelines governing letters of credit, unless otherwise stated, an LC is deemed to be answer B irrevocable. A site LC requires payment to the beneficiary answer B immediately upon presentation of complying documents. Is issuance LC deferred payment LC provides for payments answer B after a specified credit period from the date of shipment site as agreed between buyer and seller. Question. Co-lending arrangements between banks and NBFCs as per RBI guidelines primarily aim to answer enable NBFCs to originate and banks to jointly fund loans, particularly for priority sector, leveraging NBFCs' reach and banks' lower cost of funds. Under RBI's digital lending guidelines, disbursement of loan amounts must be made answer B directly into the bank account of the borrower without any pass-through account of a lending service provider. A back-to-back letter of credit is typically used when answer B an intermediary trader uses an LC received from the ultimate buyer as security to open a second LC in favor of the actual supplier. A revolving letter of credit in one where answer A the credit amount once utilized is automatically reinstated for further drawings up to a specified limit or period without fresh insurance. Development of a letter of credit occurs when answer B the applicant buyer fails to make a payment on the due date and the issuing bank has to honor its commitment to the beneficiary, converting the LC exposure into a funded liability. Invocation of a bank guarantee refers to answer B the beneficiary making a claim demand for payment under the guarantee upon the applicant's default in contractual obligations. When a bank guarantee is invoked and the bank pays the beneficiary, the resultant bank funded exposure on the applicant borrower is generally treated for asset classification purposes. Answer B. Based on the norms applicable to the existing credit facilities of that borrower, factoring the devolved liability into overall exposure and recovery conduct. Under RBI's co-lending model, the priority sector lending, the bank is generally required to take a minimum shares of the individual loan amount on its own book of. Answer B. At least 20% with the NBFC returning the balance. Under the co-lending framework, ultimate borrower rate of interest is decided. Answer B. As a blended rate agreed upfront between the bank and NBFC as per a pre-signed agreement disclosed to the borrower. Under RBI's digital lending guidelines, a key fact statement must be provided to the borrower before loans executions containing. Answer B. Standardized, simplified disclosure of all-inclusive cost of credit, fees, and other key terms. As per RBI's digital lending guidelines, the cooling off period allows the digital loan borrower to answer they exit the loan by paying proportionate APR without any penalty within a specified period after disbursement. Negative lien as a form of comfort taken by banks refers to answer B, an undertaking by the borrower not to create any charge incumbents on a specified asset in favor of any other party without the bank's consent. Compared to a hypothecation charge, a negative lien is considered answer B, a weaker form of comfort since it does not create an enforceable charge security interest on the asset on only a contractual undertaking. Thank you very much for your patience. All the best to all. Request to like, subscribe and share.